All right, let's dive right in. We're going to break down the massive macroeconomic forces that are really driving this bull market in hard assets like gold. Forget the day-to-day noise for a second. We're going to look at the core data, the why behind what's happening, so you can really get a handle on this market.
So where do we begin? Well, let's start with what just happened. We just saw a trading day that was, frankly, a total shock to the system. I mean, equities took a nosedive, the dollar shot up, and silver had its worst single-day collapse on record. Pure chaos.
But that brings us to the most important question, right? For anyone seriously looking at this market, you have to ask, does a crazy day like that actually change the big picture? Has the fundamental reason for being in hard assets, has that gone away?
Well, if you ask Michael Hartnett, the chief investment strategist at Bank of America, the answer is a hard no. His core thesis is completely unchanged. He calls it debasement is the base case. And what that means is the long-term trend, this whole idea of currency debasement, it's still the main event.
Okay, so let's dig into that. Pillar number one of this whole thesis is the political push for a weaker US dollar. And you really need to get this. What we're seeing isn't some random market swing. No, this is a deliberate, calculated policy move.
And the data backs this up completely. I mean, look at this. Since January 2017, the US dollar index is down 12%. Again, that doesn't just happen by accident. It's a strategic play with very specific goals in mind.
So what are those goals? Well, the big one is that a weaker dollar gives a shot in the arm to manufacturing, especially in those crucial Rust Belt states. And check this out. There's a direct link, a clear correlation between a falling dollar and rising presidential approval ratings. All of a sudden, currency policy becomes this incredibly powerful political weapon.
You see, it all comes down to this cycle. If you look at history, whenever the dollar enters a bear market, it typically falls by about 30% on average. This is the textbook definition of currency debasement, where the value of fiat currency, government money, is deliberately weakened. And when that happens, where does money go? It flows into real assets, things like gold, that can actually hold their value.
So, if you accept that this currency debasement is happening on purpose, it means we have to completely rethink how we invest. The old playbook, it just might not work anymore.
That classic 60-40 stock and bond portfolio, it's really struggling in this environment. The data is pointing towards a different model, what's called the permanent portfolio. And the idea is actually pretty simple but really powerful. You just divide your money equally, 25% each, into 4 buckets. Stocks for growth, bonds for some stability, gold to protect against exactly this kind of currency risk, and cash to keep you liquid.
And how's that worked out? Well, the numbers really speak for themselves. The 10-year annualized return for this strategy is a very solid 8.7%. That's its best performance in more than 3 decades.
And to really see the power of this in action, look at 2025. That portfolio returned 23%. That's the best single year it's had since 1979. It's just a huge validation that having hard assets like gold as a core part of your strategy makes a ton of sense right now.
Hey, just a quick pause here. If you're finding this analysis valuable, if this is helping you connect the dots, please do us a huge favor and hit that like, share, and subscribe button. It really helps us out, and it makes sure you don't miss any of our future updates as we track these massive market shifts.
All right, so if this is such a powerful long-term trend, what could actually derail it? What stops this train? Well, if you look at the data and what's happened in the past, it's not going to be your average market correction. It would have to be something much, much bigger. A real systemic shock.
The price of gold right now, it's not some crazy bubble. It's actually a pretty logical reflection of what the market is anticipating. And what's it anticipating? Exactly what we've been talking about. Negative real interest rates, a flood of excess liquidity, and a US dollar that keeps getting weaker because of policy decisions. And history gives us a really clear lesson here. These great gold bull markets, the ones driven by these deep currency issues, they don't just peter out. They don't end with a whimper. They end with a bang. It takes a bigger event to come along and completely flip the script, to reverse that entire logic of where money is flowing.
So that's the key, right? What could that bigger event be? Let's get really specific and break down 3 core risks that are on our radar. 3 things that could actually trigger a reversal. Okay, risk number 1 is all about concentration. Just look at these numbers. Non-US investors own a staggering amount of US assets. We're talking 64% of the stock market, 55% of corporate bonds, and half of all government bonds. This creates this massive structural dependency on foreign money. It's kind of like building your house on stilts that someone else owns. So let's try to quantify that risk. What would happen if those foreign investors got a little nervous and decided to sell off just 5% of their U.S. stocks and treasuries? Well, that would unleash a $1.5 trillion wave of capital flowing out of the country.
And here's why that number is so terrifying. A $1.5 trillion outflow, that would be unbelievably hard for the U.S. to absorb. Just compare it to the country's other big numbers, a $1.4 trillion current account deficit and a $1.7 trillion budget deficit. There's just no easy way to plug a hole that big.
So let's pull this all together. There are really three core risks we have to watch. First, that bigger event we talked about. Some kind of macro shock that forces everyone to sell assets to pay down debt all at once. That's deleveraging. Second is capital flight, a mass exodus of money out of those super concentrated foreign holdings in the US. And third, what if your safety net fails? There's a real risk that the traditional safe trade, like long-term government bonds, doesn't actually protect you this time, simply because there's so much debt in the system.
And that leaves us with the ultimate strategic question, doesn't it? In this era that's being defined by currency debasement, what's the greatest risk? Is it not participating and missing out on the upside? Or is it failing to see the bigger event that finally brings this entire cycle to a crashing halt?